All right, let's look at first conversation now. We see Nigeria's capital market and asset management industry is undergoing a period of transformation shaped by shifting economic policies, regulatory reforms, and rapid technological innovation. While recent recapitalization moves and policy interventions have spurred new fundraising activity, questions remain about how effectively companies can access both local and international pools of capital. At the same time, the rise of fintech and digital platforms that's reshaping how asset managers operate, creating opportunities for wider participation, but also exposing persistent gaps in investor confidence and financial literacy. Today, we'll take a closer look at the current landscape, examining how regulation, technology, and market sentiment are influencing capital raising, the growth of asset management, and the future of investor participation. Well, joining us to unpack this, we have Dr. Sonnie Ayere is the Group CEO, DLM Capital Group. Join me right here in the studio. It's great to have you, sir. Good morning.
Thank you, Lanny. How are you?
I'm fine.
Very good.
Yeah, it's a brand new week, and I guess a brand new week to raise money or make money.
Yes,
you know, at this point, you know, depending on where you play. But you know, we've seen a lot, you know, happen in 2025 first half. We've seen the banks, you know, trying to raise capital. Seen some banks, you know, meet that, you know, capital target raise before the deadline, and some are still waiting.
Some are still working on it.
working on it at this point. So, you know, talk to me about the landscape, you know, so far. How are you seeing everything play out?
Well, look, we're talking about the banking capitalization now. Right. I mean, look, I think it's been very positive for the banks. You've seen share prices of banks actually leapfrog. I just saw this morning now that Premium has reached the 200 billion mark, which is, you know, the minimum for a national bank. Zenith was, I think, the first to cross. And I think, you know, what I see is investors feeling confident. You know, the only competition right now, of course, is the insurance industry, which recently also came up with two things. They came up with new rules, which obviously strengthens the insurance industry. But more importantly, now the regulator has also increased the capital. So again, investors are looking at how to allocate capital also into the insurance industry, which generally speaking is always, you know, that long-term capital. So if you look at the insurance industry, say for instance in the States and other climes, that's where you find the longest capital that exists. You know, so it's a very competitive landscape.
I'm talking about competition, and I'm just imagining that I'm an investor, you know, right now, and you know, the banks have come to me. To get money. I'm giving the banks money. Maybe I don't have that much to give to the insurance guys. You know, at this point.
No, I mean it has to be. It's down to really capital allocation now, and taking, let me say, a longer term view. I mean, if I go back to me as many years ago when I used to be on the buy side, you know, what I would be looking at right now is taking a long-term view. How do I see the regulation or the laws impacting the insurance sector? One of the problems with insurance is really, we don't have an insurance industry, but it's really compliance, you know, and enforcement. Because for instance, if you create a law that says my car must be insured, how is it going to be enforced? Okay? If it's enforced, it's fantastic because it means there's a monthly cash collection that goes into the insurance industry on a regular basis, and so on and so forth. Those are the kind of decisions I'll be looking at to ensure that, okay, well, how do I see the long-term industry for insurance vis-a-vis the banking industry? My 2 cents worth is that both industries will thrive. It's inevitable. All right? With the kind of population that we have, growth that we have, let me call it I would say the knowledge, you know, in terms of the youth, and where my prediction in terms of another 10, 20 years, the impact of AI and so on and so forth, it's inevitable that both industries will thrive. So my view would be that as an asset manager, you should be looking to allocate some of your capital into the banking industry and some into the insurance.
And how you seen the, you know, regulatory landscape, you know, so far?
For which industry?
Looking at, you know, the banking industry, you know, see what's playing out with insurance, you know, at this point. How's all of that, you know, impacting, you know, how you do business?
Let me start with the banks. I think I think the central bank has done fantastically well since the new team has taken the helm. They've helped to stabilize the naira. Let's be honest. The economy has really sort of gone from this sort of choppy perspective to a more, where you can say there's confidence going forward. Paying off there was a lot of debt when they came in, if you remember. The CBO owing FX, you remember all
the backlog.
The backlog, it was kind of a complete mess.
Right.
And I think, to bring in that team and actually stabilize the system, I think has been perfect. And I think the recapitalization was also as a matter of, either you write off, the bad loans you have, which of course would affect your capital, or you bring in fresh capital. It's one or the other. There was no in between. And I think the central bank decided to go for the additional capital buffers, which makes a lot of sense. So I think from a regulatory standpoint, they've done a great job. There are those who argue that the banking sector is overregulated, but in an environment like this, you need to really hold your bells and whistles, if you know what I mean. In terms of insurance, one thing I tend to notice, I've been working in Nigeria now this is my 20th year.
Wow.
Since 2005. And one thing I tend to see is that, once the central bank moves, other regulators move. I would not be surprised, for instance, if my primary regulator, the Securities and Exchange Commission, also came up with new capital requirements in due course. Yeah? It's just kind of like it's like
a domino effect.
Yeah, like domino effect, basically. And in a way, it also makes sense because, again, you want to keep track. You don't want banks way too capitalized than, say, for instance, investment banking area space, right? Or banks way too capitalized than, say, insurance. There has to be some sort of balance. So as one moves up, it makes sense that the others also sort of like follow through. It makes a lot of sense,
right?
I think.
And talking about the space at this point, you did mention AI, at some point, and we're seeing the rise of the fintechs, the landscape, and they're changing the way a lot of things,
yes,
happen. How financial services, how we, consume those services. So, talk to me about what you're seeing, so far, because I know where the money is flowing.
Well, I think. If I had to separate traditional banking from, say, digital banking, I think the main separator would be, lending. So if you look at the digital banks, they tend to focus on consumer lending, all right, whilst the traditional banks tend to look at, high-end, lending, if that, right? So if we focus on digital, the impact of AI is beginning to manifest in, say, for instance, areas like customer service, where, rather than having, remember in those, if I went back 10 years, you'd have a warehouse-looking thing with lots of people, phones, and,
right,
talking to customers. In the next 3 years, that's going to all disappear. You wouldn't even be sure whether you speak to a person or a robot, because it will be as interactive with you just like a person. Okay.
Maybe with some emotions.
Even with that, yes, because basically, I've seen some tests and I've heard some tests, and it's amazing what's going on there in terms of incorporating AI into into what let me call it customer interaction. Then you also have, I would say, the impact of that area. Digital banks, that is focusing mainly, like I said, consumer lending and also SME lending, and which is part of the reason why we also looked at, and we'll talk about that probably later, the composite bonds as a way of actually providing financing to that sector, because we feel that one of the most important areas in developing the Nigerian economy is obviously supporting and investing both the SME sector, which is like supporting the supply side. So the SME is the supply side, but if you're giving funds to a business to grow its business, the way that it becomes successful is how? There has to be people buying, right? And that means that you've also need to fund the demand area, which is the consumer, all right? The consumer needs to basically be able to leverage their incomes, raise monies, borrow monies to either buy the cars or buy the this or buy whatever. So that becomes the balance and the equilibrium between the supply and demand side of things. And AI would certainly, inevitably, play a major, major role in the transformation of that market going forward, because starting at consumer interaction today, that would move to all other things, machine learning. I mean, that's already been there, so how you pay, what you pay, how much you earn, how you move your monies, etc. That's all been recorded. That's all data analysis, where you're putting all that information together to take a decision. So right now, if you look at the nano loan space, what I mean by nano loan space is loans of, say, 5,000 to 100K, for instance. A lot of the decisions as to whether you get the loan or you don't get the loan is not human. No, that is all completely artificial intelligence, machine learning. Yeah, because the time for a person to go through that credit analysis to lend 10K.
AI will know that you didn't pay back 10K.
Absolutely. It knows that you didn't pay that 10K. It knows that basically you have either a loan or whatever outstanding with another bank, with another credit bureau, right? It knows how much you earn. Okay, right. It's all about information, and then basically putting all that information together to take a decision. So it is inevitable that a lot of these
AI will not say, because you're going through some problems right now.
No.
Maybe you should still get that loan. No, it's going with fact.
No, it will go with fact and decide whether you do or you don't.
Right.
But I will give you an example where AI can actually have emotions. Where, for instance, it's saying to you, Mr. Williams, you're owing XYZ. And you say, well, look, things are difficult for me right now. I'm in between jobs, etc. It says, okay, you know what? Let's hold off. Let's give you some time to get a job. All right? We'll come back to you, say, maybe in 3 months' time and see whether things are better. Or I can get somebody to actually speak to you and let's work out something that might make sense. Yeah.
That's nice.
Yeah, so it's not just, so it's not cut and dry, like, no emotion, no whatever. And the thing is, this is just the beginning. I mean, to me, it's actually scary.
I know.
Where AI will go in future. Because it would actually get to, I was listening to an ex-Google guy this morning talking about how he expects that the sort of like the capacity of AI would probably, right now, humans are the ones inputting information. Now you're going to get to a point where AI is the one actually putting the information in to improve itself. By that time, you're getting smarter than even the human.
I just pictured AI just saying, I am inevitable.
Yeah.
So,
we don't want to Terminator.
No, we don't want Terminator.
Exactly.
Okay, so, at this point, let's look at some of the projects. I know you're working on some projects at this point, and it's an interesting type of bond.
Yeah,
it's like the best of two worlds.
Correct.
Because it's hard to hear safe and high return.
Yes, in the same. Correct.
If it's safe, it should be low return.
Yes. Yeah.
So talk to me about that.
Yeah. So that we christened it sovereign composites. Sovereign composite notes, and the whole idea is the word composite means to put two things together. So the whole idea is to bring in FGN bond cash flows, okay, and then also mix it with real sector cash flows. So when you put both cash flows together, you can see one of the reasons why you have a higher return. That's number one. Number two is that it is designed in such a way that your principal, which is the money you part with, and the interest you're expected to earn, okay, is 100% backed by FGN cash flows. What that means basically is that whether real sector monies come or they don't come, you as an investor are guaranteed to get your principal and your interest back from FGN. Okay?
And does that take most of the chunk of the investment, the fund?
Yeah, so the money that is actually invested, right? The way it's designed, the monies that are invested, the entire monies are actually invested in government bonds. Okay? But the repayment required to ensure that you, the investor, is repaid, because it's an amortizing bond. What I mean by amortizing is I'm paying back principal and interest. Okay? If it's a bullet, it means I'm only paying interest and I will pay you the principal at maturity, at the end. So because I'm paying you that principal and interest, it means that obviously the amount of interest I will pay to you will be less. Think about it. If I borrow 100 naira from you at 10% to pay you 100 naira at the end, maybe I'll just pay 10, 10, 10, 10,
right,
with 10% of 100, right? All the way down, right? And then pay you 100 at the end of the transaction. If I paid it on an amortizing basis, let's say I was paying it and I was paying you 10 naira every year. So the first year I will pay you 10 naira, right? 10% of 100.
Right.
The next year I will pay you 9 naira, 10% of 90, right? Because I'm paying you back 10 naira of your principal.
Right.
The following year I will pay you 8 naira, right? And then 7 naira, 6 naira, because obviously I'm paying down your principal by 10 naira every year, right? So you can see now already that the interest I'm paying is reducing, as opposed to paying 10, 10, 10, 10, 10. So you can already see the arbitrage between a bullet and an amortizing.
Right.
So that's exactly what we do. So from that perspective, because I'm paying you, because it's an amortizing bond, it means that what I need to pay you, right, is out of the entire bonds I bought, I only need 66, 2/3. In other words, 2/3 of the bonds, okay, and all the interest income on it. I assign and use that to pay you. That means I have a balance, all right? Now that balance, if it was say 30, which is what we're doing right now, that balance would be 10 billion. So in other words, 20 billion of the amount that I've raised is for you. The interest component on all 30 is for you, but I still have 10 billion. What do banks ask for when you want to borrow money from a bank?
Collateral.
Thank you. So I've got 10 billion of collateral. And the best collateral available in the country, which is what? FGN bonds. So if I place that with a bank, it can now give me real cash that I can now use to do what? Fund the real sector.
All of the fund goes to the FGN bonds?
Correct.
So there's no risk?
No, zero.
I like no risk.
Yeah, no. So when it gives good return. My dear brother, when we were putting this together, yeah, you know, it actually sparked from a thought of how can we come up with a product that gives investors, whether it's asset managers, pension fund managers, you know, DFIs, etc., a transaction that actually they know they would get their full money back, right? But at the same time, can also give them a good yield. Now, where does that yield come from? It's very simple. What we did was, instead of, like I said to you, we've talked about a bullet and amortizing, right? But now we're amortizing the bond, okay? Normally, just like I said before, if I'm owing you 100, I pay you 10 naira. I'm now owing you 90. So normally, my 10% would be based on 10% of 90. If I pay another 10, it should be 10% of 80, and so on and so forth. Now imagine I'm actually paying you 10 naira every year, but I continue to pay you 10 naira. Can you see that your return, now it gets to a point where I'm paying you 10 naira interest over 10 naira principal. Is that not 100% return?
That's 100%.
Thank you.
Wow.
You see? So what we designed, because we now have two sources of cash flows, we're now in a position to actually give you that kind of return, whereby instead of paying you 10, 9, 8, 7, we actually pay you 10 all the way down, but you're actually reducing the principal balance. Therefore, that's how you get that upward return curve.
Fantastic. Exactly. And that's what investors love.
That's it. So
they wanted to go up.
Well, that's what we had hoped that investors would love, because the whole idea was that to give you a return that actually gives you at least 2 to 2.5 times what the federal government is paying you, hold to maturity. And people like pension funds should have been absolutely, you know, you should love this, because for the first time, you know, something is telling you that my 10-year return not only gives me a high return of investment, but the biggest threat to pension funds has always been what? Not even just pension fund, bond fund managers. Inflation. All right? So you buy a fixed income security, let's say it's 15% per annum. Inflation goes to 20, you're under the water. Now imagine having a bond that, as inflation goes up, is actually going higher than inflation. In other words, helping you to hedge the risk of inflation. So we've done something that we believe, from the investor side, gives you Very little risk. I mean, the one we're doing, and it's like we said, we're not doing it as a transaction. It's actually a product. We've given it to the market. We'd like to see it mushroom as a new product where investors are able to now, improve the credit quality of their portfolio. So, for instance, if you look at a normal corporate portfolio,
right.
You might have triple B, single A, etc. Now imagine, I had this portfolio, 50% of them are in sovereign composite, which are triple A, and 50% in normal corporate bonds, A, triple B, etc.
Right.
On a weighted average basis, what have you done? You've significantly improved the credit quality because now you have 50% of your corporate bond portfolios in triple A. That's number one. Number two is that you now have 50% of your portfolio giving you at least 2 to 2.5 times the return of FGN.
Fantastic. Well, there's so much to unpack at this point, and I know this conversation will definitely, keep going. But thank you so much for helping us unpack this. Dr. Sonnie Ayere is a Group CEO, DLM Capital Group. Thank you so much for giving me imaginary money at some point, because I kept hearing, "Laddie, take 10 now, Laddie, take 100." Well, thank you so much,
no problem.
for coming out today.
Thank you.
All right, sir. Thank you so much.
Thank you.